Welcome to your Mortgage Insider Update for February the 23rd. We are one day away from the PCE, Personal Consumption and Expenditure Report, the Fed's favorite level of inflation measure. That comes out on Friday. So in anticipation of that, we've really been running into some headwinds. The CPI report, the wholesale inflation numbers that have come out and just in the last few weeks has moderated inflation, but has not come down significantly. It's actually barely coming down. Some of the wholesale inflation actually went up slightly. So as we jump into the charts, we'll see how we stand. Okay, here's our market update for today, February the 23rd. We've got the 10-year Treasury down 2 basis points, which is a welcome relief. We see the chart here over the last 6 months. We've seen highs back in October. We came off those highs and hit them again and then have stayed well below it for a long time. So year to date, we're looking at the highest rates on the 10-year Treasury specifically all year in 2023. We've got the reaction from the Federal Reserve minutes this last week and the Federal Reserve meeting from the beginning of February, where they did raise the short-term interest rate by 0.25%. 25 basis points, and they're looking to do it again with the most recent CPI inflation data. We also this week get PCE, which could show moderating inflation, but the overall wholesale and consumer inflation reports that have come out this month are not giving us any relief. So if we get into the mortgage-backed security market, mortgage-backed securities are going to work in the reverse. So as the price was higher here on February 2nd, that was representative of much lower interest rates. That was actually one of the best points this year so far. We've had that reverse. So as these prices have fallen, the interest rate to the consumer has gone up. We're looking to have bounced off some of these retracement levels. If we go back to that same 6-month chart, we can see rates have gotten on the price has backed down to levels that we had seen back at November of last year, and we've been improving as those prices increased. For the most part, we've been on a relatively uphill trend on the 25-day average. It has flattened out, and then just most recently, we're looking to go on the negative side for interest rates. Okay, so as we can see, the mortgage-backed security market and U.S. Treasury market is responding to lack of information, just some reports coming out. This week we had the minutes from the last Federal Reserve meeting. It does indicate that most of the Fed members are still leaning towards a higher inflation or higher rates on the federal funds rate to really capture and tame inflation. The one problem with that is that all their efforts and everything they do, even though they're only increasing 0.25% per time, I believe that they're trying to get to at least 5%. But right as they get there, we're going to start to see, as the spring rolls on, less and less inflation, and likely to see less than 5% inflation, which that would be a turning point where the Federal Reserve would have to really consider, did they go too far? We won't know until spring gets here, and in the meantime, stay warm.